When a business buys goods with the intention of reselling them, it is acquiring an asset. Following basic double-entry rules, the logical step is to record this by debiting the inventory asset account and crediting payables. But the instructions in the ACCA F3 textbook often present a direct contradiction to that intuition. There is a clear discrepancy between what seems intuitively right and what the exam demands. Instead of debiting an asset, the textbook instructs you to debit an expense account called purchases. If you are confused by this, your logic is actually accurate. Debiting inventory directly is exactly how modern computerized systems handle these transactions. However, the textbook instructions are also accurate for the specific framework required by the syllabus. You aren't making a mistake. You are witnessing the difference between two distinct accounting frameworks, the perpetual system and the periodic system. The perpetual system is a continuous tracking method. Under this framework, the inventory asset account is updated in real time with every single transaction. The periodic system is a checkpoint method. Day-to-day inventory movements are ignored, and the actual stock value is only calculated at the end of the financial year. If you use accounting software like Xero or SAP, you are using a perpetual system. It relies on automation, which is why early career professionals instinctively default to it. The ACCA F3 exam, however, tests your grasp of manual accrual accounting. To ensure you understand the mechanics beneath the software, the syllabus focuses on the periodic system. To pass the exam, you have to temporarily set aside software-driven intuition and learn how to operate within the mechanical constraints of a manual framework. Let's map out how a transaction flows under the modern perpetual system to see why it feels logical. The moment you buy goods, you debit inventory, immediately increasing your balance sheet asset. When you make a sale, you record the revenue, debit receivables, credit sales. Instantly, a second entry happens, debit cost of sales and credit inventory, physically reducing the asset balance as items leave the warehouse. This provides real-time accuracy without any need for year-end adjustments, but it demands significant computing resources to track the exact cost of every single item at the moment it is sold. Now, imagine running a high-volume retail business using only pen and paper. If you sell hundreds of items on a busy Tuesday, calculating the specific cost of goods sold for every single transaction by hand is manually impossible. To keep the business moving, manual accounting relies on a workaround. It bypasses the inventory asset account entirely during the trading year. Under the periodic system, the cost of incoming goods routes directly into a temporary expense account labeled purchases. At the point of sale, the business records only the revenue, debit receivables, credit sales, and the stock movement itself is ignored. This creates a specific technical limitation. Throughout the year, the inventory asset account remains frozen with last year's numbers, and the actual cost of sales for the current year is unknown. The only way to solve this unknown inventory problem is to halt business operations at the end of the year and physically count everything left in the warehouse. This physical count process provides the exact final variable needed to reveal the true cost of goods sold. Let's test this logic using an actual scenario from the F3 textbook. Example 1, featuring Amit's ink cartridge shop. Look at this data from Amit. First, opening inventory, $67,500. Next, purchases, $129,600. Finally, the physical count reveals $34,800 remaining. These numbers feed the periodic equation. Cost of sales equals opening inventory plus purchases minus closing inventory. This single equation acts as a mathematical bridge. It calculates the total cost of goods sold for the entire year at once, eliminating the need to track individual daily sales. The final step for the F3 exam is translating Amit's mathematical equation into official journal entries to update the ledgers. Step 1 requires us to remove the opening inventory. By debiting cost of sales and crediting inventory, we clear out the outdated asset balance from the start of the year and move it into the current year's expenses. The second step is to close off the purchases account. We transfer the entire accumulated total from the temporary purchases account directly into the cost of goods sold account. The final entry is to post the closing inventory. We debit inventory and credit cost of sales. This establishes the new, accurate asset value on the balance sheet for the start of the next year. After executing these 3 specific journals, The manual periodic system outputs the exact same accurate financial statements as a modern software system. For the exam, follow one strict rule. Unless a question explicitly states a company uses continuous records, assume they use the periodic system. When you practice with the Kaplan exam kit, keep this framework in mind. Use the purchases account, and do not try to update the inventory asset account on every single sale. Mastering the distinction between perpetual software logic and periodic exam logic provides the technical foundation for the entire F3 inventory syllabus.